Dear guests, ladies and gentlemen, welcome back to the Lámfalusi Lectures Conference. After more than a decade of low interest rates, central banks are fighting inflation again. High public debt poses a challenge for monetary policy in many countries, as monetary tightening limits the space for fiscal policy through their higher interest rate and burden, as well as slower GDP growth. The second panel discussion, titled Interaction between Fiscal and Monetary Policy, will focus on one of the most topical questions of today's central banking. Is there a conflict between price stability and full employment? Should either fiscal or monetary policy play a dominant role? Is the period of low interest rates over? Can central banks lose control over inflation? Participants of the panel discussion will search for new answers to these old questions. Our moderator will be Mr. Dániel Palotai, alternate executive director of the IMF. Welcome. Please give a warm welcome to our distinguished speakers, Mr. Alan Auerbach, professor of economics and law at the University of California, Berkeley. Welcome. Mr. Harold James, Professor of History and International Affairs at Princeton University. Mr. Jean Boivin, Head of BlackRock Investment Institute. And Mr. Péter Kažimír, Governor of Národná banka Slovenska.
Dear Governor Matolcsi, dear ladies and gentlemen, colleagues and friends, it's really a pleasure and honor to be here in this very, both, I would say, disadvantageous and also very fortunate panel discussion. We are disadvantages very much because the only thing between the audience and the delicious lunch is us. So we have to earn not only the attention, but also, as it was said by Jacob Frankel, in the previous discussion, the credibility. And we are also in a difficult situation because John Lipsky said just a few minutes ago that everything has been said already for the fourth speaker in the panel. Now, this is valid for all of us in this, as the previous panel really touched upon the fiscal monetary cooperation, central bank credibility as a main theme. Nevertheless, we are also very fortunate because the experience we have at the table, both from the theoretical point of view and also from a practical point of view. We have here Professor Alan Auerbach, who has not only been a professor at the Harvard University, University of Pennsylvania, but also University of California, Berkeley, but he has worked on the other side. From the experience he knows, he has advised various administrations in the US. He has been a director of the Burr Center for Tax Policy and Public Finance, and also Chief of Staff, Deputy Chief of Staff of the US Joint Committee for Taxation, so he knows what he's talking about. And we also have here a living library, Honorable Professor Harold James, the IMF's historian, from whom I personally learned a lot during my last 4.5 years at the International Monetary Fund. He knows all the country examples from the last at least 100 years, maybe more, from fiscal and monetary cooperation. And we have also very distinguished practitioners. Jean Boivin, who is not only a head of the BlackRock Investment Institute, but he has been, as you might know, before the deputy governor of the Bank of Canada, and he also worked on the other side, on the fiscal side, as assistant deputy finance minister. No less experienced is Governor Kažimír, who before becoming governor of the Central Bank of Slovakia, he also was a finance minister for, I think, 7 years at least, and a deputy prime minister for certain years. So he has also seen both sides and does understand the trade-offs, the challenges, and has all the experience which we need for this panel. Let me now turn to our topic, the fiscal and monetary policy coordination, which is very much linked to the other ideas raised this morning of central bank independence. They are definitely closely interlinked. And we will try to find where is the thin difference between independence, dependence, cooperation, and dependence. Where does cooperation end? Where does dependence begin? It was also mentioned this morning, we have learned from Madame Lagarde, President Lagarde, in her presentation, that central bank independence was not really known several hundred years ago. It was picked up in the middle of the 20th century, got significant traction, was very widespread in the 80s. That was, I think, one of the key principles of mainstream liberal economics. It was like an idealistic principle. You cannot even question it. The more independence, the better it is. But is this really the case? Is this really the case that the more dependence, the better it is for the overall outcome of the countries? One could say, yes, central banks should be independent, otherwise they couldn't pursue the inflation targets. Of course, we know that central banks did not always have inflation targets. We in Hungary adopted a modern central bank act in 2001, which in the run-up to the EU accession, central bank was made fully independent, both financially, but also from a legal point of view. And that has worked relatively well for most of the period, but not always. And let me just recall one period where I think it did not really work in Hungary before I give the floor to you. That was a period after the global financial crisis and during, when in Hungary, the foreign currency mortgages were very widespread, mainly in Swiss francs. Of course, Hungary is not really linked to the Swiss economy, but it seemed a good idea before, mainly from a banking point of view, to issue cheap, seemingly cheap mortgages in foreign currency. And there was a very independent central bank who was keen on being independent. And when the then serving Minister for National Economy, his name was György Matolcsy, approached the central bank, let's convert foreign currency mortgages to domestic currency because this is very risky. Then the very independent central bank told the minister, no, this is not possible. The reserves belong to the central bank. We can't help you with this. And I think this is a very good example when full independence without cooperation yields a suboptimal outcome. Luckily, that period ended. As Prime Minister Orbán said this morning, every mandate ends at once, and also the previous governor's mandate ended once, and Governor Matolcsy became the governor in 2013. And one of his first tasks he had given to his staff, including myself, who was the chief economist back then, was, guys, you have to address foreign currency mortgages. We have to eliminate this, because this could be a disaster. You have to do something about it. Now we are in the central bank. We can talk to the finance minister, who happened to be Minister Mihály Varga, and let's work out something that we can convert foreign currency mortgages. And it worked out. We just did it at the right time, as you might recall, a couple of months or maybe a few weeks before the Swiss National Bank, the SNB, decided to eliminate the cap on the franc, and which would have been a major disaster for Hungary. So I think this is a good example demonstrating that too much independence without cooperation may not yield a good outcome for the country, but still independent, but with cooperation, a central bank can very much pursue the national goals, the interests of the national economy. What is your view on all this? So I would maybe give the floor to you to say your general statements on central bank independence, fiscal and monetary policy coordination, and then of course we can dig a little bit deeper and go into more specific questions. Alan, can I start with you?
Sure. Well, I think you've raised the critical question for our panel, and I think that first of all that central bank independence is important. I'm convinced it's very important empirically. And I think it's going to be under serious challenge in the coming years, precisely because of increasing government indebtedness. Certainly true in the United States, but it's true in many other countries as well. And I think as interest rates rise, as they are now rising, we'll be reminded that the mix of high debt to GDP ratios and high interest rates can be very toxic, and also put a lot of pressure on in the independence of central banks. A second general point I wanted to make that perhaps will come up again in our discussion is that the line between monetary and fiscal policy has always been fuzzy. That is, you can always think of simple things like seniorage, which we think of as part of the operations of a central bank, but it is in a sense a fiscal policy. But I think in the last couple of decades, the line has become fuzzier, and I think it also may have shifted, both because of the global financial reactions to the global financial crisis, especially, as well as to COVID, in that the traditional roles of the central bank of providing liquidity and dealing with inflation through the setting of policy rates has been expanded through the purchases of assets beyond the standard assets, and through the kind of cooperation that you mentioned in your opening comments that happened here in Hungary. And I think that while there may be benefits of cooperation and coordination, I think there's also a danger of fiscal dominance occurring to the extent that the central bank is not simply coordinating, but essentially following the lead or the instructions of the fiscal authority. And another general point in thinking about, given that we are here in Europe, although we're not sitting in the Eurozone, is that I continue to think that there's a underlying problem, logical problem in the Eurozone experiment, which is the difficulty of coordinating monetary and fiscal policy when you have so many different countries setting fiscal policy and such heterogeneity in terms of the economic conditions in these countries. And while Jacob Frankel said in the last panel that the stress on the euro was fought off during the financial crisis, and that should be considered success, I think one can't declare victory yet, because I do think that there is an underlying problem there in the design, that is, in the existence of independent fiscal authorities without any kind of fiscal union or even transfer union in Europe, at the same time as trying to have a single monetary policy. And I think that ultimately will cause problems in the future, even if these problems have been overcome in the past.
Thank you very much, Alan. And I promise we will come back to this issue of fiscal monetary cooperation within the single currency area, the euro area, a little bit later. But let me now give the floor to Jean to also provide some remarks on fiscal monetary cooperation.
Great. First of all, thank you very much. It's a great honor to be here, and it's been already an amazing start of the conference. Glad to be here. I'll make a couple of observations to get the thing started, but I think we'll come back to some of them. I hope, because otherwise I will come back. But I'll just highlight a few things that are I think top of mind here for us for that question. So first of all, I think this idea of independence. I agree with Alan that. It's been working, it's important. I think it's difficult to take the other side of that. At the same time, in practice, there's a bunch of questions that arise, and it's a lot fuzzier. And you've alluded to that already, but I think, in 2019, we wrote this paper in August of 2019 about how to deal with the next big downturn. That was, pre-pandemic. It was actually a few months before the pandemic, but we were trying to conjecture on how we would have to deal with this. And I think we were of the view at the time, and that's what we laid out, that like any kind of response to a significant shock would force us to go and blur the distinction between fiscal and monetary policy even further. So there's all of the points you've made already, but every step of crisis response, I think, pushes the boundary between the two even more. And in a world where you thought that maybe the interest rates were like extremely low already to start from, in 2019, the yield curve was flat and it was extremely low. The ability to hope for the interest rate channel to be effective, I think, was difficult to rely on. And that would have led to questions around more direct ways to try to stimulate the economy. And I think any of those ways, even if they were kind of enacted or pushed by the central bank, would have even more of a fiscal flavor to them. And so that is one reason. And then the second reason why it's fuzzier in practice is that if you start from a large debt level, and you have to expand monetary policy or expand fiscal policy in a significant way, I think there are big questions around how interest rates and market would be reacting to this. These questions didn't really present themselves for decades, since the 1980s. But sitting in 2019, we were not convinced that we could take for granted that interest rates would stay low if we were to deploy very significant fiscal measures. And the question then would arise about what would policy do, monetary policy do in response to that? Would it let interest rates just do whatever they want? Would it try to lean against long-term rates increasing? And one way or the other, even if there's no explicit coordination, it could raise the perception of coordination. And we thought that it was better to try to lay out a framework ahead of doing that, rather than be forced into this kind of even fuzzier world. The reality is we had the big shock coming after. The shock was of a very different nature than what we were envisioning, so I'll come back to that's one thing I would like to come back to later. But we kind of saw most of what we expected to happen. So we saw massive fiscal policy being deployed. We got 4 times the fiscal impulse in the US that we had in the GFC for something that ultimately was a quarter of the shock. So that was a massive deployment of fiscal policy. We've got questions arising now about how we're going to get out of this. And that movie is not over. We haven't seen exactly how the US would be able to deal with rising interest rates and dealing with inflation at the same time. And one thing I want to maybe mention in light of the previous panel, as much as I would love the playbook that we've been using to be well established and ultimately be the one we're going to be using, we haven't been in this situation where we have to deal with inflation with that high debt level. We haven't been there. So Volcker, early 80s, didn't have to worry as much about the implication of high interest rates on the debt level as much as we will have to do now. So the conflict that's going to create, to me, is real. And so that's why, as much as I believe in central bank independence, I don't think it can be taken for granted. And I've always thought that central bank independence is not something that you just assert. It's something that you need to manage. And that management, I think, is going to get very tricky now going forward. But I'll stop here and come back to other points after.
Thanks much, Jean. We will definitely come back to the issues you raised. I give the floor now to Harold, please.
Thanks so much, and it's a great pleasure to be here at the Magyar Nemzeti Bank, and thank you, Governor Matolcsi. So the fundamental theme has already, I think, clearly been stated, that the critical question is the relationship between growth and interest rates, so the RG story is absolutely at the center of this. And I think if you take a long-distance view of the subject, you can see very quickly that the idea of central bank independence was fundamentally popular and promoted because it was justified in terms of pushing down interest rates. So the academic argument is different, of course, and Sylvester talked about that very nicely and has written a great deal about it. The academic argument was different, and it was about the theory of it and why central bank independence would give a better inflation performance. But the attractive quality of this for politicians was that it would reduce the borrowing costs. Pulling down the interest rates by having credible independent central bank or policy autonomy for the central bank is going to make it cheaper for the government to borrow. And that's the attraction for the UK but also why countries like to join the euro in the 1990s, that for Italy it radically, for instance, reduces the borrowing costs. And now we're in a completely different environment where the signs are reversed, as it were, and the borrowing costs are going up, and governments are very worried about that. So last year, the United States spent more on interest payments, the federal government spent more on interest payments than it spent on defense. And that looks difficult. And if you put that into the future, and we've seen over the last months the surging yields, this looks more and more problematical. I think it fits into the topic of this whole conference in terms of the age of geoeconomics and geoeconomic uncertainty, in that this is a moment when governments are wanting to or needing to spend more on defense, and consequently, the argument about the borrowing costs has a key element of security, and this adds, in my view, a completely new dimension to the story. Well, is it a new dimension? It's actually a very old one. The Bank of England was founded in 1694, and one of the things that scholars of central banks do is to look at the statutes of a central bank and to ask, why is the central bank created? What does it say in the statute? Is it about price stability? And the only purpose that's specified in the Act of 1694 that created the Bank of England was to prosecute the war against France. So it was solely to do with managing the security of the British Crown, then engaged in this long conflict with Louis XIV, and to bring down borrowing costs. If you think of the critical moment in the history of the Fed and in the Fed-Treasury relations in 1951, this is after the president summoned in the whole of the board of the Fed to tell them that the United States was fighting a war in Korea and that the government debt couldn't be more expensive, so the government needed to lean on the monetary authority. In that sense, the more we're in an age of geopolitical uncertainty and geoeconomic contestation, the more this theme about security will become important. And let me just add one other thing, that when we think about cooperation, and cooperation is clearly a public good, and it was beautifully expressed in 1944 at the Bretton Woods conference, when Treasury Secretary Morgenthau started it off by saying that prosperity and peace are indivisible. You can't have just prosperity in one country alone and the rest of the world is consigned to a garbage can. You can't have peace in one country alone. You can't be peaceful alone. That was the lesson of the 1930s. So prosperity and peace are indivisible. And you go, for instance, into the foyer of the Bank for International Settlements, and it tells you that the aim of the institution is promoting monetary and financial stability. And that's the good message. That's the message of 1944, of Bretton Woods. But in a moment of geopolitical contestation, it actually becomes attractive to run raids against the currency of your opponents. And so the story that Jeffrey Sachs started off this morning with about the tech stock plunge and the surge in a new Chinese company is exactly one of those instances where, and they're repeated again and again in history, before the First World War, before the Second World War, countries tried to destabilize the finances of other countries because that allowed them an advantage. If you destabilize the finances, if you push borrowing costs up, then you make it more expensive for that country to spend on the military and you weaken its capacity. So France in 1911 did that against Germany in the context of the Moroccan crisis. Germany in 1938, as the clouds of war were gathering, did that against France to deliberately destroy the French military capacity. And so you're going to see, I think, an era in which we think of the stock exchange, the capital markets, as a weapon, and they're going to impact on the borrowing costs. Thank you.
Thank you. Very interesting points, and thanks you also for raising the US example. We will try to come back to that if time allows. But let's now hear from Peter. Maybe you could also a little bit touch upon euro area fiscal monetary coordination, but we can also come back and discuss it together at a later stage if you wish so.
Firstly, thank you, Daniel. Firstly, thank you for having me here. It's really a great honor to be the part of this panel. And I think from the perspective of economic governance, the fiscal and monetary policies are two sides of the same coin. And it's true that I've been flipping this coin for nearly 2 decades. And, firstly, as a finance minister, now as a central banker. And I must say that to talk about this, the topic, I do have a feelings like Dr. Jekyll, Mr. Hyde story, because it's really not easy. Because it's, by definition, you know, the finance ministers and governors now are not in the same boat, you know, always, you know. So because this temptation to play the blame game, it's really pretty high, especially when inflation it's very high, which just we remember now. Also, I must say that what Harold has said, that this borrowing costs are pretty important. So we were the best friends of finance ministers with very low rates, but we are not anymore, you know. So due to natural reasons. So I remember that time of the debt crisis, you know. So I was in the room when all these issues we dealt with Irish case, with Greek case, with Portuguese case, with Spanish case. Maybe it's better not remember all the details. And Jacob has said that we passed the test. But I fully agree with you, Alan, that this issue is still here, because, you know, all we know that the architecture of our monetary union, this is not true monetary union, and we have a lot of gaps which we have to fill, and there's no political will to do it, you know. So we are not agile to do it. So we have to be very cautious in this. Okay, we passed the test that time, and we have to be ready for another one, definitely. And in practice, during this crisis, the boundaries between the fiscal and monetary policies have been very hazy, you know. So, but in reality, there are two join at the hip, and a relationship. They can promote stability, but they can also generate a lot of risk. What happened also in the past in some countries, also in the members of Eurozone. So, for example, in my view, the one reason why the US recovered much faster from the pandemic was the design of their monetary union and what's the design of its monetary and fiscal alignment. I think it's quite visible now. But also, I don't agree that fiscal policy should counterbalance interest rate levels. Instead, fiscal policy must avoid creating some pre-inflationary pressures, again by definition. But looking at the situation after the COVID, I was a member of the old guard. You know, I was very close ally of Wolfgang Schäuble at that time, and probably you know that he was a big promoter of austerity policy. From today's perspective, it's considered this austerity as a policy mistake. Many people, you know, so they just told us that, okay, that was a mistake. I do not agree with that. I was really there, so my fingers were in this game. So, and that was the crisis of trust also, you know, and we had to deal with it in this way. But in comparison, if you see the finance ministers now, we raised the generation of finance ministers who are spenders, you know, they are bloody spenders, and it's not so easy, you know, just to go back, because you are addicted, you know, for the money, because the spending, this is the general remedy, you know, for everything. And from this point of view, I think it's hopefully we can talk also about market discipline, which I do believe is somewhere here with us.
Thank you, Peter, for explaining a little bit both sides of the same coin. I believe it is the same coin, and I would say it's maybe the same ship, because they are in a different situation, but if the ship sinks, then both the governor and the minister will have to grab something to stay afloat with. But good points made. You mentioned, I think Jean mentioned that the line is a little bit blurred when economies come under pressure and there are crisis times. I think this is what you were pointing at. And I agree with you that at crisis times, there should be perhaps more cooperation between fiscal and monetary than in normal times. But of course, this is a good question. Are there any normal times anymore? And I would also maybe raise a question whether you think that the cooperation should be different if there is a supply side shock which hits the economy or a demand side shock which hits the economy. Traditional theory tells us that if there is a demand side shock, then central banks are more efficient in dealing with the demand side shock and managing the demand fluctuations, stabilizing the economy, while they are a little bit less equipped with proper tools when there is a supply side shock. But we have seen a number of huge supply side shocks in recent years, from the COVID disrupting supply chains, from geopolitical tensions related energy price surges, food price increases. What can monetary policy deal with that, and how can the central bank support governments addressing these issues? Maybe you could also link your responses with the COVID response we have seen in various countries. And I will just open the floor and look at who wants to come first. Harold, please, I saw your hand first.
Yeah, thanks. That's indeed absolutely right. That fundamentally, both monetary and fiscal policy, these big aggregate policies, work better against demand shocks. And that's the critical lesson. I think it was learned correctly in 2008 in terms of dealing with the global financial crisis out of the Great Depression. And you want to get money everywhere. You want to get demand everywhere. And so there was this nice phrase, I think it's Jeremy Stein, who says money gets into every crack, and so you send money everywhere. In a supply shock, on the other hand, in a negative supply shock, you have specific shortages, specific constraints. So at the beginning of COVID, it's protective equipment and face masks and medical stuff and ventilators. Then it becomes semiconductors because everybody needs semiconductors in order to build the electronic machinery to communicate in the aftermath of the crisis. Then you get a war, and then you need particular kinds of equipment. So it's very, very targeted and it's very precise, and that's not what monetary policy is doing very well. And if monetary policy spreads it out, does the Jeremy Stein story, what happens is simply that you get so much demand that you're actually making it more difficult to supply the critical supply gaps. And that's, I think, a lesson. I draw it from the middle of the 19th century when there was a massive negative supply shock in Western Europe, from the 1970s as well. And the world turns in those moments to thinking about the movement of relative prices and what it means in particular for government efficiency, targeted, precisely targeted programs.
Thank you, Harald. Who wanted to come next? Alan, please.
Yes, I agree with that very much. I don't think the issue of monetary and fiscal policy coordination, I don't think the coordination should be different in the two circumstances. I think the real point is that stimulus, whether it comes from the monetary authority or from the fiscal authority, is much more effective in response to demand shocks than supply shocks. And so the real issue is recognizing supply shocks. I think this was a particular issue, certainly in the United States and I think elsewhere, not in dealing with the initial shock from COVID, but in dealing with the recovery from COVID and the supply restrictions, the supply chain disruptions that were present in economies then. And I think to some extent misdiagnosing that as a need, a weakness that needed to be responded to by stimulus. In the U.S., at least, it wasn't necessarily something that monetary policy took the lead on. It was fiscal policy, which was, pretty much over the top in terms of its response. when the basic problem was supply disruptions. But monetary policy played a role too, in the sense that it waited, the Fed waited in retrospect too long to counteract what fiscal policy was doing, which in turn was not really responding to the situation as it was.
Thank you. Yeah, please.
Yeah, building on that, I think this distinction between supply and demand shock is crucial. And I think it's broader than COVID. We think it's a much bigger story, in fact. So to me, I mean, one useful observation is that if you go back to Jackson Hole 2002, there was a paper presented there by Jim Stock and Mark Watson at the time, and it was about the Great Moderation. It was whether it was good luck or good policy. And they made the case in that paper back then, it was 2002, that maybe luck had a lot more role to play than we were giving credit to, or we were giving maybe too much credit to a good policy. Of course, that was at Jackson Hole, so it was not necessarily well received or didn't get a lot of traction in that crowd at the time. But I think now, more than 20 years after, I think there's a lot of truth to this paper. So the idea was that the environment in which policy was being made since the early 80s was very different. The type of shocks that we were facing were very different. And that has made good policy having more traction. So there was certainly like better framework in place. There was better monetary policy being executed than before. We had learned some lesson, but we were able to do that because we were also facing very favorable demand type shocks. We think since the COVID was a manifestation of that, but we think the environment we're in right now is one that is shaped by supply. It's not a cyclical story that we're going through at this moment, in our view. It is really a transformation. People have used the word transition. Transformation for us also means that this is about the makeup of the economy that is evolving, sectoral reallocation, AI is transforming everything. Geopolitics is rewiring the world. These are all things that have to do with the supply side of the economy. They are also secular in nature. They're more structural in nature. And so monetary policy, as was mentioned, is much less well-targeted, equipped to deal with this type of transformation. And it's not only COVID, it's much broader than that. And I think at this juncture, so that leads to a couple of implications. So I think the Fed, or the discussion we've been having over the last few years is heavily influenced by a cyclical lens on the situation that is not really a cycle. I think that's maybe why the response to inflation was delayed. I think it's also surreal for me to some extent to see how much consensus there was last fall on the need to start an easing cycle. This was all predicated on a cyclical view of the world and the risk of recession and so on. Not obvious, and the consensus on that, the fact that there's no one that is actually arguing for raising rates or maybe keeping them on the table, I think speaks to a pretty profound kind of cyclical lens that is applied to, again, something that has more structural features, supply limitations, and ongoing inflationary pressure that at least should be maintained as a risk on the table. And that leads to, again, that point of independence, which will be tested, I think, is that if inflation is more persistent, continues to be driven by these kind of supply forces, if we have less favorable shock, sharper trade-off, it's not only a question of growth and inflation trade-off that we have to deal with, but it's also debt and rates trade-off that we haven't really faced. And how are we going to deal with that? And I think to the point you alluded to, there's fiscal dominance we have to be worried about, but there's also financial dominance that is a risk, right? So we think we are currently in a pretty fragile equilibrium where I think there's not necessarily a fundamental reason, but it's been taken for granted that rates are anchored at some kind of low level that has been challenged a little bit now. We've seen them drifting. But that's a pretty fragile equilibrium. So if we see a very rapid adjustment in rates, will that then lead central banks to back off? And that would be financial dominance. And again, these are kind of trade-offs that we haven't really faced in the Great Moderation period. And the playbook that we have might not be totally well suited for that.
Thank you, Jean, and thanks for bringing to the table the idea of structural transformation and megatrends which really continue to shape the landscape and the environment we operate in over the very, very long term. Peter.
Okay, so again, I think the Jacob gave us excellent lecture in previous panel how to deal with supply side shocks. So that hands are almost empty. I think it's pretty important to be very transparent here and not to raise the expectations. And back to the COVID and the energy crisis, I think we made it, you know, but was extremely that was extremely costly. Why? Because I think our policy recommendation was please do introduce the measures which are temporary and targeted. And the result was 80% of measures were not targeted, you know, as usually, you know. So that was the reason that it was really extremely costly. And in energy prices, when we are talking, so my humble view is that we really failed as a union, because with COVID, without it, but we made it, but with energy prices, in coordination, I think we failed. And maybe one interesting thing, we just conducted survey back home about the central bank, about the credibility, and after the COVID and after all this episode of with high inflation, surprisingly, the credibility of central bank went up, but less and less people believe that we do something with inflation. You know, so this, I call it a big paradox, you know, so they trust us, but they do not believe that we can do something with inflation, you know, so.
You had our last hope then.
Yeah.
Thank you very much. Let's turn a little bit to the US, and I would turn to Alan first. And I studied one of your papers back from 2017, in which you wrote that government spending shocks do not lead to persistent increases in debt to GDP ratios or cost of borrowing. And I'm wondering how you see this today against the fact that in the US, the public debt in percent of GDP surged from 105% now to over 130%, and then still around 120%. And I also read your very recent paper on robust fiscal consolidation, where you estimated the optimal fiscal response to a temporary deficit shock like a COVID and a persistent interest rate shock. So I'm wondering, against this, how would you explain the policy responses in the US?
Well, thank you. The first paper you mentioned, which was also for Jackson Hole, the Jackson Hole Conference, what we found was that a fiscal reaction to shock, to demand shocks, did not necessarily increase borrowing costs or debt to GDP ratios when undertaken in weak economic circumstances. That is, it was a state-specific finding. And it followed on some earlier research we had done, which was consistent with that, which was a finding in support of countercyclical fiscal policy. Unfortunately, it was not a result saying that fiscal stimulus always has that property, and in particular, fiscal stimulus adopted at the wrong time, when the economy is not in need of it, does not have such salutary effects because it doesn't cause GDP to get stronger, because there isn't that much room in the economy for that to happen. And that leads into the results of the more recent paper, which is that the US in the 80s and 90s did have a fiscal policy that was responsive to the debt situation. Stronger projected deficits led to fiscal consolidation. In the last 2 decades, that relationship, that behavior has disappeared. So even as the US debt to GDP ratio has risen substantially, the appetite for the government, for undertaking responsible fiscal policy and effective fiscal policy, that is, stimulating the economy in response to negative demand shocks, but also adopting measures in the direction of consolidation when the economy is strong and the debt poses a challenge, that behavior is a thing of, at least currently, a thing of the past. And so the U.S. is going into the next several years when we face the challenge of a high debt-to-GDP ratio and rising interest rates with a government that appears, at least politically, ill-equipped to deal with it.
Thanks very much. Very clear, and again, this underlines what you said before, that we have to understand the situation where we are, because the optimal policy response is state-dependent, and also we have to understand the nature of the shocks. Would any of you like to come back on the U.S. policy coordination, or shall we rather move on? Okay. Related to this topic is whether even in advanced economies, do we have fiscal monetary coordination right? Of course, the room for maneuver is very different. Just looking at the first year after COVID, in advanced economies, the average fiscal response was 10% of GDP. For emerging markets, that was rather 2.5% of GDP, definitely much less space for maneuver. But I could also say that for monetary policies, the room for maneuver is very different for a large central bank issuing a reserve currency, or for a small central bank which has maybe not abundant reserves. There are definitely very difficult trade-offs. But also in advanced economies, the challenges are always there, and one cannot be complacent. I was shocked when I looked at the example of the Silicon Valley Bank disaster. We saw that in advanced economies, they can just do it right, but obviously this is not the case. Can you maybe share some experiences on insights between advanced economy and emerging market coordinations, room for policy maneuver? Who? Harold.
Sure. So the advanced economy umbrella is obviously sometimes very, very leaky. And I think one of the critical experiences, and it still scars many people, is the story of September and October 2022, with the brief, short-lived government of Liz Truss in the United Kingdom, and a big fiscal measure, so tax cuts, unfunded tax cuts, about £45 billion. You know, in a big perspective, if you put it in terms of GDP, it's not an enormous share of GDP, and it's difficult on the face of it to see why people were so panicked by it, but they were panicked by it. And so you get this moment when the sell-off in terms of government debt creates then an unexpected position in large financial institutions, and particularly in pension funds. So it's not so much a banking problem, but it's a problem in pension funds. And at that time, there was a lot of discussion about whether this wasn't a kind of warning for other economies, and particularly, you know, there's a long story of thinking about the UK as a kind of outlier of the US, and the UK as giving early warning signs, early warning symptoms. And, you know, I think, you know, that's also the implication of what Alan was saying, that the position, if you're thinking about big tax cuts, unfunded tax cuts, is a very, very uncertain one.
Thank you very much. Anyone wanted to come in on this before I move on? Maybe as a next question, I could, as the last question, because we are running out of time, I would ask you about the changing mandates of central banks. Many central banks are now focusing on environmental sustainability, greening of the financial system. Also, the Central Bank of Hungary has a very clear three-pillar strategy on green finance and sustainability. Many central banks are actively communicating. Obviously, this is very close to the area of government fields of different fiscal policies, regional policies, structural policies, and very, very long-term structural issues. So I'm wondering whether you think this is a good avenue, a good direction we should be going, and whether this makes fiscal and monetary coordination more difficult, and whether there should be more coordination if and when central banks go into these areas. Alan, please.
Yeah, I don't want to be unpopular, but I think that there's two distinct issues here. One is, should central banks be cognizant of the implications of climate change in their assessments of economies? And I think the answer to that is surely yes. To the extent that there may be risks to economic outcomes because of climate change or related phenomena, I think that absolutely is a central issue that central banks should be considering. Whether central banks should play an active role in facilitating government responses or national responses to climate change is an entirely different issue. And I think here this is clearly a task for fiscal policy, and I don't see any comparative advantage to monetary authorities in dealing with this. For example, through providing low-interest loans to companies in certain industries to help accelerate economic transition. I think subsidies may be perfectly appropriate in these cases, but those are elements of fiscal policy. And to the extent that governments are acting in the interests of their countries, they should be adopting these. Now, the governments may politically prefer that monetary authorities do the job for them, but that is a characteristic of fiscal dominance. And I think it's a dangerous road to go down. And I really do think that in this case, monetary authorities should be focusing on their key objectives and not undertaking fiscal policy on behalf of governments.
Thank you, very clear. Jean, please.
I mean, to agree with this and maybe to even expand beyond the transition itself. So I totally agree. I think not only central banks, but I think the financial sector needs to get smarter collectively about how the transition will evolve, what will be the risk associated with that, what will be the opportunities that will be generated, the sectoral transformation that is coming from that. And so the same way we need to, in the financial sector, be smart about what central banks are likely to do and try to forecast what they will do, not what they should do, but what they will do. We also need to think and develop like models and forecasts about how we think the transition will unfold. Now, how it should unfold, that's a question for society, but how it will is something that we need to get a handle on. But more broadly, as I was mentioning before, like there's a real big transformation that is going on, and I think we can debate how much we've seen similar things in history, but I don't think it's something that we've seen during the Great Moderation during the last few decades. And this is structural in nature. It's not cyclical. And I think that leads to, I don't want to be unpopular either, but I think it leads to, central banks were the only game in town for a long time after the financial crisis. I don't think that's the case in the transformation we're talking anymore. I think this is, they have a role to play on maintaining inflation on target and so on, but I think that transformation is more structural and other tools are more appropriate more broadly.
Thank you. And Harold, please.
Sure, I don't disagree. I mean, I think this is one of the instances of the blurring of the fiscal monetary and of fiscal authorities pushing things onto monetary or authorities. But in that sense, I mean, the green transition is also a question of security in a sense. It's an environmental security. And the logic of it is very, very similar to military security, that if this is an urgent national task, governments will do it, but it's costly. And so it's going to push up the fiscal deficits and the debt level.
Thank you, Harold. Peter, you have the last word.
Daniel, I will quote the official ECB position, okay? So we are deeply committed to addressing climate change, all while staying within our mandate. Honestly, to be very honest, I would be very sober here. So I fully agree, Alan, with you because we should not, raise many, many expectations. We can provide, we can be the center of excellence. We can provide expertise in this area, in many areas, in structural policies. But hocus pocus, to focus on many, just to to deal with that in a very innovative way, it could be the source of to tread our independence in the future, I guess.
Thank you very much. I want to thank all of you for your excellent insight and thoughts. And now let's conclude this panel and let the audience convene for our lunch and then continue in the afternoon with other discussions. Thank you very much.
Thank you very much, Mr. Palotai and dear panelists, for this dynamic discussion. And yes, indeed, it's time for lunch. But before that, let me tell you that the lunch break will have some cultural program as well. For our online audience, we will have a 2-hour break now. And at 3 p.m., the Lámfalusi Lectures Conference will continue with an exciting roundtable discussion, bringing together previous Lámfalusi awardees. And then during the lunch break, we have a special program for our guests. We invite you to watch an MNB original film starting at 1:45 p.m. titled The Foundation, directed by Attila Szász. The movie tells the exceptional story of the establishment of the independent Hungarian central bank in 1924, focusing on the role of Sándor Popovics, the first governor of the Magyar Nemzeti Bank. And now it's time for lunch. Thank you very much, gentlemen, for patiently waiting here on stage for this text. Thank you.